Chapter 1: A Kid from Queens. In a modest neighborhood in Queens, New York, a boy was born in the summer of 1949 who would one day manage more money than the economies of entire nations. His name was Ray Dalio. His father was a jazz musician who played clarinet in Manhattan nightclubs. His mother was a homemaker. There was no Wall Street pedigree here, no trust fund, no family fortune waiting in the wings. Just a restless, curious kid who hated school and struggled to memorize the things his teachers wanted him to remember. But Ray had something the classroom couldn't measure. He was obsessed with figuring out how things worked. To make pocket money, young Ray took a job caddying at a local golf course, hauling clubs across the green for some of the wealthiest businessmen in New York. And as he walked those 18 holes, he listened. The men around him talked about one thing constantly: the stock market. It was the 1960s. The market was booming, and everyone seemed to be making money. So at just 12 years old, Ray took the caddying cash he'd saved and made his very first investment. He bought shares of a company called Northeast Airlines for one simple reason. It was the only stock he'd heard of that traded for less than $5 a share. He figured he could buy more shares, and if it went up, he'd make more money. It was naive logic, but fate smiled. The company was on the verge of bankruptcy, got rescued by a merger, and Ray tripled his money. In that moment, a lifelong addiction was born. The market was a puzzle, the greatest puzzle of all, and Ray Dalio wanted to solve it. He kept investing through his teenage years, building a small portfolio. He went on to college, discovered he actually loved learning when it was on his own terms, and clawed his way into Harvard Business School. After graduating, he landed on the floor of the New York Stock Exchange, trading commodities, the wild, chaotic world of futures contracts on everything from cattle to grain. He was sharp, aggressive, and unafraid. But Ray had a problem with authority. He couldn't stomach being told what to do. After getting fired from one firm, reportedly after a New Year's Eve incident, he made a decision that would change financial history. In 1975, at the age of 26, working out of a two-bedroom apartment in New York City, Ray Dalio founded a company. He gave it an ambitious, almost grandiose name for a startup run out of a spare bedroom. He called it Bridgewater Associates. There were no employees, no clients, no skyscraper office. Just a young man, a few telephones, and an unshakable belief that he could understand the machine of the global economy better than anyone alive. He had no idea that within 7 years, this dream would nearly destroy him completely. Chapter 2: Building the Machine. In the beginning, Bridgewater Associates was not a hedge fund at all. It was a tiny advisory business, scraping by, helping corporate clients navigate the dizzying volatility of currency and interest rate markets. Ray Dalio had a gift, and it wasn't just numbers. It was the ability to see the world as a system of cause and effect, an enormous interlocking machine where every action triggered a reaction. While other traders chased gut feelings and hot tips, Ray began writing down his reasoning. Every prediction, every trade, every assumption, he put it on paper so he could later examine where he'd been right and, more importantly, where he'd been wrong. This habit would eventually become the foundation of his entire philosophy. To keep the business alive, Dalio started publishing a research report he called Daily Observations, sharp, opinionated analysis of where the global economy was heading. It built him a reputation as a thinker who saw connections others missed. Then came the breakthrough that put Bridgewater on the map. The fast food giant McDonald's was preparing to launch a new product, the Chicken McNugget. But there was a problem. The company was terrified that the price of chicken could spike and wipe out their profits. Dalio devised an ingenious hedging solution, breaking the cost down into its component parts of feed, corn, and soybeans, allowing McDonald's to lock in stable prices. The McNugget could go to market. It was the kind of creative, systematic problem-solving that defined Dalio's mind. He wasn't just guessing, he was engineering certainty out of chaos. Clients began to take notice. Pension funds, corporations, and institutions wanted a piece of the man who seemed to understand the hidden gears of the economy. Money started flowing in. Confidence grew. And Ray Dalio, the kid from Queens who tripled his money on a dying airline, began to feel something dangerous. he began to feel certain. By the early 1980s, the global economy was a powder keg. American banks had lent staggering sums of money to developing nations across Latin America. Inflation was raging. Interest rates had been jacked up to brutal, punishing levels. To Dalio, studying his charts and his history books late into the night, the pattern was unmistakable. He could see the dominoes lined up. He could see, with crystal clarity, exactly how it was all going to collapse. He calculated that the debt these countries had taken on was simply too enormous to ever be repaid. A catastrophe was coming, a financial reckoning of historic proportions. And Ray Dalio was about to do something that no cautious money manager would ever dare. He wasn't going to whisper his prediction quietly to a few clients. He was going to shout it from the rooftops, stake his entire reputation on it, and bet the future of his company that he was right. It would become the single most important mistake of his life. Chapter 3: The Bet That Broke Him. In August of 1982, Mexico did the unthinkable. The nation defaulted on its debt, unable to pay back the billions it owed to American banks. To Ray Dalio, it was vindication. This was it, the first domino. The catastrophe he had predicted was finally unfolding before the world's eyes. Other Latin American nations would follow. The American banking system, drowning in bad loans, would buckle. The economy would spiral into a depression rivaling the 1930s. Dalio was now absolutely convinced he had cracked the code. And so he did something extraordinary for a young money manager. He went public, loudly, confidently, and without a shred of doubt. He was invited onto Wall Street Week with Louis Rukeyser, one of the most watched financial programs in America. Looking into the camera, Dalio delivered his verdict with total certainty. He declared that the economy was heading for a depression. He even testified before a committee of the U.S. Congress, telling lawmakers the same chilling forecast. There would be no soft landing. There would be collapse. He positioned his money accordingly, betting heavily that the markets would crater. He bought gold and treasury bond futures, wagering everything on disaster. And then, the unthinkable happened. The exact opposite of everything he predicted. Instead of collapsing, the American stock market began to rise. Not just a little. It launched into one of the greatest bull markets in the entire history of the world. The Federal Reserve, under Chairman Paul Volcker, moved to ease monetary policy. Capital flooded back into the system. The economy, far from sinking into depression, began an explosive 18-year boom that would mint fortunes for an entire generation. Ray Dalio had not just been wrong. He had been spectacularly, publicly, catastrophically wrong. On television, in front of Congress, in front of every client and peer who had trusted his brilliant mind. The losses were devastating. The money he managed evaporated. And as Bridgewater bled, Dalio was forced to do the most painful thing of all. One by one, he had to let his employees go. These were not just colleagues. They were friends, people he had worked beside, people whose families depended on those paychecks. He let them all go until there was no one left at Bridgewater Associates except Ray Dalio himself. The empire he had spent 7 years building was gone. He was back to square one, alone, in a small office, his reputation in tatters, his confidence shattered. It was, as he would later describe it, one of the most painful experiences of his entire life. He had been so sure, so arrogant, so certain that he was right, and the market had humiliated him in front of the whole world. The kid from Queens had bet everything on his own genius, and he had lost it all. Chapter 4: Borrowing from his father. Rock bottom has a very specific feeling, and Ray Dalio knew it intimately in the aftermath of 1982. The man who had gone on national television predicting economic collapse was now living his own private collapse. His company was a shell of itself. His savings were gone. And the situation became so dire that Ray Dalio, Harvard graduate, founder of his own firm, the brilliant young mind who had just lectured Congress, had to do something deeply humbling. He had to borrow $4,000 from his father just to cover his family's bills. $4,000. After everything. He was so financially destroyed that he genuinely considered giving it all up. He thought about getting a regular job, a steady paycheck, walking away from the dream entirely. The pressure was crushing. But somewhere in that wreckage, Dalio began to ask himself a different kind of question. Not how did the market betray me, but something far more uncomfortable. How could I have been so arrogant? How could I have been so certain I was right? This was the pivot point of his entire life. Most people, when they fail this badly, either give up or double down on their ego, blaming bad luck, blaming the world. Dalio did neither. He chose to treat his catastrophic failure as the most valuable lesson he had ever received. He later distilled this into one of his most famous principles, a simple equation that would guide everything that came after. Pain plus reflection equals progress. The pain of 1982 was enormous, so the progress, if he could reflect honestly, would have to be enormous too. Dalio realized that his greatest weakness wasn't a lack of intelligence. It was his crippling overconfidence. He had been so in love with his own conviction that he never seriously asked what would happen if he were wrong. So he made a radical shift in how his mind operated. He later put it this way: he developed a great fear of being wrong that changed his thinking from "I'm right" to constantly asking himself, "How do I know I'm right?" That single question changed everything. He began seeking out the smartest people who disagreed with him, not to defeat them, but to stress test his own thinking. He wanted to find the holes in his logic before the market found them for him. He started writing down decision-making rules, principles, so that he would never again be blindsided by his own blind spots. He began building systematic checks against human emotion, against ego, against the very arrogance that had nearly destroyed him. Out of total humiliation, a new philosophy was being born. Ray Dalio understood now that the market was bigger than any one genius, that certainty was the most dangerous trap of all, and that the only way to survive was to assume you might always be wrong. From the ashes of 1982, he was about to build something the financial world had never seen before. Chapter 5. Rising from the Ashes. Slowly, painfully, Ray Dalio began to rebuild. But this time, he was building something fundamentally different. The new Bridgewater would not run on one man's gut instinct or burning conviction. It would run on principles, written down, battle-tested rules for making decisions, designed to eliminate the ego and emotion that had nearly destroyed everything. Dalio created a culture he called radical transparency and an idea meritocracy. At Bridgewater, the best idea was supposed to win, no matter who it came from. Junior employees were encouraged to challenge senior ones. Meetings were recorded. People rated each other openly, brutally, in real time. It was uncomfortable, jarring, and not everyone could handle it. But the goal was singular: to find truth. Because Dalio had learned the hard way what happens when you fall in love with being right. As he would later write, an accurate understanding of reality is the essential foundation for producing good outcomes. The core of his rebuilt strategy came from the lesson of 1982 itself. He had been destroyed because he bet everything on a single outcome. So he devoted himself to a new question: how do you build a portfolio that can survive any economic environment, no matter what happens? This obsession gave birth to the famous all-weather approach, designed to balance risk so that growth, recession, inflation, and deflation could never wipe you out. He launched the flagship Pure Alpha Fund in 1991, built on rigorous, systematic analysis, and the results spoke for themselves. Money began flowing back to Bridgewater, first millions, then billions. Pension funds, governments, and sovereign wealth funds entrusted their capital to the man who had transformed his greatest failure into his greatest strength. But the ultimate test came in 2008. As the global financial system stood on the brink of total collapse, as Lehman Brothers fell and panic gripped the world, most investors were annihilated. Bridgewater, however, had seen the debt crisis coming. Dalio's team had built models that tracked exactly the kind of debt buildup that triggers catastrophes, the very dynamics he had misjudged decades earlier. This time, his analysis was rigorous, stress-tested, and humble. While the rest of Wall Street burned, Bridgewater's Pure Alpha Fund posted strong gains in a year that destroyed countless rivals. The contrast was staggering. In 1982, certainty had ruined him. In 2008, disciplined doubt had saved him and his clients. The boy from Queens who once borrowed $4,000 from his father was now managing tens of billions and climbing toward over $150 billion in assets. Bridgewater Associates had become the largest hedge fund on the face of the earth. Dalio had not just recovered, he had built an empire on the wreckage of his worst mistake, proving that the way you respond to failure matters infinitely more than the failure itself. Chapter 6. The Lesson Written in Pain. By the 2010s, Ray Dalio stood atop the financial world. Bridgewater Associates managed more money than any hedge fund in history, at its peak overseeing some $160 billion. Dalio himself had become a billionaire many times over, his personal fortune climbing into the tens of billions. He advised central bankers and world leaders. He was named one of the most influential people on the planet. And yet, the most important thing Ray Dalio created was not a fund or a fortune. It was an idea, a way of thinking forged entirely in the fires of his greatest defeat. In 2017, he took the private rule book that had guided his rise and published it for the world. The book was called simply Principles. It became an international bestseller, read by millions of entrepreneurs, students, and dreamers who would never manage a dime of his money but desperately wanted to understand how a man rebuilds himself from total ruin. At the heart of it all was that equation born in the wreckage of 1982. Pain plus reflection equals progress. Dalio had learned, in the most brutal way possible, that failure is not the opposite of success. It is the raw material of it. He had been so certain, so arrogant, that the market had stripped him down to nothing. But instead of letting that defeat define him, he interrogated it, dissected it, and extracted from it a wisdom that would carry him for the next 4 decades. He came to believe that the greatest danger in life and in markets is not being wrong. It is the inability to admit that you might be. He warned about the seduction of certainty, observing that those who try to predict the future with total confidence are destined to be humbled by it. He built an entire institution around the radical idea that you must constantly ask, how do I know I'm right? The story of Ray Dalio is not really the story of a man who got rich. It is the story of a man who lost everything because he was certain, and then built everything because he learned to doubt. The 12-year-old caddy who tripled his money. The young founder who bet his company on a prediction and watched it crumble. The humbled man borrowing $4,000 from his father. And finally, the architect of the world's biggest hedge fund. Every chapter connected by a single thread, the willingness to face painful truth without flinching. In the end, Ray Dalio's real fortune was never measured in billions. It was measured in his ability to turn his deepest humiliation into his greatest teacher. He failed more spectacularly than almost anyone in finance, and precisely because of that, he succeeded beyond what almost anyone thought possible. The lesson he leaves behind is as simple as it is hard to live by. Embrace your mistakes, because they are trying to tell you something. The only question is whether you're humble enough to listen.